Hello everyone. My name is Vikas Agrawal and I'm the founder of a company called AIF and PMS Experts India. So AIF is your alternate investment funds and PMS is nothing but portfolio management services. So we are emerging as one of the largest platform for investing in alternate investments and portfolio management services. So in a way that we are like an interface between the good portfolio manager and the investor community as a whole. So when I laid down the foundation of this organization, there was one thing in my mind that there are because I spent about 2 decades in the industry before starting up this company during the COVID time, is that there are good quality deserving portfolio managers, but they have limited bandwidth to reach out to investors. And there are really good quality investors. They really need help of good portfolio managers, but they don't have an access to those portfolio managers because of X, Y, Z reasons. Because A, the industry is highly scattered, and B, there is no connection in between. So what I felt is that why not we would create a platform where we invite the deserving portfolio managers to come and speak to all of us, share share their valuable experience and wisdom with all of us. And then if we have additional funds to be deployed, we can sort of give them a mandate to manage funds and take the relationship to the next level. So we do our due diligence at our level because we curate the portfolio. Before we recommend any portfolios, we have a sort of 56 parameters in which we evaluate these portfolio managers and their schemes to get the beta levels, to get the information ratio, etc. And then allocate funds. So you can reach out, you can either visit aifpms.com or reach out to any of our experts who will help you with that. So again, it's a very special day. We've been organizing these kind of knowledge-based sessions for quite some time. And with me, I have Mr. Pawan. Pawan has done extremely good job. Before I come to the kind of work that Pawan has done, let me have the privilege of introducing Pawan to all of you. Well, Pawan brings about almost 2.5 decades of experience on the table. So that gives him more wisdom, I would say, more than experience to sort of understand. Because in 2.5 decades, he would have seen dot-com bubbles, then he would have seen Lehman Brothers crisis, then he would have seen Brexit happening, then RERA and GST implementation, and then you have GST, the COVID thing which happened. So that gives him more wisdom in terms of understanding because he has held various serious positions in some of the private equity companies, and to my mind, those who have worked in the private equity setup, when they come on the listed side, process do not change. So they manage the listed equities in the same fashion where you actually onboard the companies and handhold them, sit on their board and help them to grow. So similarly, they come with the same approach of a long term, identifying companies at an early stage of their growth curve and riding through the growth journey, which is very, very important. And we thought, why not we would invite Pawan and understand more from him. So he's a chartered accountant and graduated from Mumbai University. So Pawan, thank you so much for taking the time out and accepting our request and joining the session for our investors.
My pleasure, Vikas. Thank you so much for having me over. It's a most difficult session to do on a Friday afternoon post lunch.
Yeah.
So thankful to all the people who are there.
Yeah. I'll just share the formats. What we'll do is maybe you start with your thought process. Maybe if you have any presentation to share, you may talk about your investment philosophy first, and maybe if you can throw some more lights on, how did you manage to start this company and what is the thought process, and then we'll have Q&A. So the total duration is 30 minutes. You may take 15 minutes and we'll have 15 minutes of.
So I don't have a presentation handy. That's not what I was prepared for, but I can just run you through in terms of what we do at Equitree Capital. So like you rightly mentioned, what we do is take the private equity approach to investing into public markets. So, unlike most of the public market investing, where people try to play the markets, where everybody's clued into the market prices and the momentum, what we like to do is look at the businesses and understand the businesses and take meaningful minority positions in these businesses and hold on to those businesses from a longer term perspective. That's what we look to do when we say take the private equity approach. So coming from the private equity background, what I realized is a lot of listed companies which exhibit similar kind of characteristics as those of unlisted companies. These are typically long-standing businesses, family-run businesses. A lot of these are leaders in their own right, and sometimes at an inflection point for extremely high growth. That's what we look for, and that's a potent combination for us to have. And if we find these kind of opportunities, then that's where we look to buy stakes into these companies, mostly from the secondary markets, because a lot of these companies are cash rich, so they don't even need primary capital to expand and grow. That's even a better situation to be in, and so that's what we look to do with Equitree.
Sure. Maybe if you can throw some lights on your how this company started, maybe a little bit about company, your fund management structure, etc., for our investors.
Sure. So Equitree, it's me and Suneet Kabra, who's my partner. Suneet and me go a long way back, where we studied together. So we actually did our CA together, and we've known each other for more than 25 years now. So post doing our CA, I started my career with Morgan Stanley and with ABN AMRO for a couple of years. And Suneet was into traditional CA practice. So we had very divergent paths. 2012 was a time when I was working with a private equity fund and just coming out of that. And Suneet was also folding up his CA practice. So we set up Equitree Capital more over a coffee conversation, two friends getting together, just trying to have some fun. And we said, okay, let's start with our own prop capital. That's how we set up Equitree Capital. And the genesis was that, all of us know that in the microcap space, a lot of people dabble into investing into microcaps. And this is a space which generally people tend to invest into through some of the other, tips or the rumors or, some of the other information that people may have here and there. Very less research goes into these kind of companies, to say the least, because if you look at the Indian markets, the research ends at the top 350 or top 400 kind of companies and nothing beyond that. That's what the genre that we looked at, and we said that if we can professionalize investing into this space, because this is a space which ends up creating the maximum wealth as well, but is also known for the maximum number of accidents. So we had to devise a strategy which works into this space where we can identify the right kind of companies and hold on to them from a longer term perspective. And that's where wealth creation actually happens. We've done that over the last 12 years successfully. I mean, one thing, we started with prop capital, and as one thing led to another, we've taken a PMS license in 2017. The meaningful fundraising actually started happening only in 2020 because 2017, when we got the license, we were actually liquidating our own portfolio because we were seeing the froth in the market and were not comfortable taking any third-party capital. So we held on, and what followed between 18 to 20 is, I think, once in a lifetime kind of a thing that went on in the Indian economy. So every time that we would think to go to the market told us that, it's not the right time.
Yeah.
So 2020 is when, we were in talks with some investors. And once we realized post-COVID that mankind is surviving, that's where we thought that, it's about time to, start taking money on board. That's where we start. So it's meaningfully, we have been managing third-party capital from 2020 onwards. Today, we manage close to 300 crores. That's the size that we are into.
Sorry, how much you said? Can you be a little bit louder, please?
300 crores.
Yeah. Okay. Yeah, I remember 2017. I mean, economy got hospitalized, I would say, in ICU in 2018 and 19. And these lessons are something that, gives more vision.
Yeah.
So maybe Pawan, if you can throw some more lights on how do you manage for the large cap, mid cap, small cap, maybe a little bit about your scheme and the performance, if you can highlight that. What do you?
So we have only one scheme, Vikas, and that's called Equitree Emerging Opportunities. And all what we do, we don't do any large cap, mid cap. In fact, that's not even the way we look at our investing, in terms of slicing it down to large cap, mid cap, or small cap. What we are more focused on is the business and the underlying valuations. If we are able to do a reasonable level of due diligence on a particular business that we can understand well, and if the valuations are reasonable, and if we see growth in that business, from a longer term perspective, it's not just 1 year. So we generally don't look at a flash in the pan kind of a growth. What we look for is there a case for a structural 20-25% kind of compounded growth that can come about in a business over a longer period of time? That's what we look for. And once we identify that, irrespective of the cap, that's where we look to invest into. Having said that, a lot of these characteristics are generally found into micro small cap space. So by default, we come down to looking at companies in the market cap range of 500 crores to going up to 5,000 crores. So that's the segment in which we invest into. But like I mentioned, while these companies are small in terms of their market cap, uh, nevertheless, these are businesses which are very, very well established, have been in the market for almost at least about 2 decades or more. So these are not new companies which are entering the market. These are companies which will have very stable businesses with revenues of ranging anywhere from 500 crores going up to a few thousand crores. Hugely profitable companies. That's something that we like. We don't like negative operating cash flows, companies which are reporting profits but not resulting that into cash flows. That's something that we're very worried about. Um, these are companies again which are either very low on leverage or maybe practically debt free. So and there is a growth opportunity where these companies are addressing very, very large markets. So when you find this kind of potent combination, that's where then we look to buy meaningful stakes into these companies. So that's what we look.
When you say emerging, so it's purely a meaning of emerging, and irrespective of the market cap, you would see the emerging story around. Is that correct?
So emerging is from the perspective that these companies may not have institutional holding or any professional investors. So generally we end up being the first professional investors into a lot of these companies. So emerging is more from that perspective. But like I mentioned, these are businesses which would have long-standing life cycle that they would have seen.
So would you mind picking up some companies, emerging stories from SME exchange also, if you think that the business model is solid and sustainable?
We haven't done anything on the SME exchange because I mean, the valuations on the SME exchange have been completely magical, if I can say, for want of any other better word. That's something that we don't really understand. And the companies are much smaller. So there are companies which are even 5-10 crore kind of PAT numbers. Those are trading with a market cap of 100 crores and upwards and so on and so forth. Uh, so we haven't done really anything on the SME exchange. But yes, if we find something which is really credible of a reasonable size and scale, we possibly may be still open to look at something like
that. Yeah. So essentially, it's 500 crores to 5,000 crores.
Correct.
Can you also talk to us that, because this is a very, very volatile segment as well, maybe if you can throw some more lights on, number one, that how do you select these businesses? Any major parameters that in which you evaluate these businesses? And how do you do that?
So yes, that's what we have done, because over the last 12 years, we've tried to perfect our systems and processes in terms of identification and analysis of the businesses that we do. So in terms of identification, one thing that we are very clear is that we don't invest into any business where we think that we may not be able to do a reasonable level of due diligence. That's extremely important to us. And when I say that, you eventually go down to doing scuttlebutt and trying to understand both the business as well as the promoter antecedents in terms of what his uh, execution has been over the recent past, what is his vision, and so on and so forth. Understanding of the macro opportunity again is extremely important to us. We like businesses which have reasonable entry barriers, or they're trying to do something which is disruptive. So, for example, we were very early investors into companies like Astral Poly. So, when Astral Poly was a very small company, even at that point in time, they, the ability to get a, Warren Buffett Group company, which is Lubrizol, to India and come up with the CPVC pipe. I mean, that was a new variant of pipe which was introduced in the Indian markets, where people were used to the cast iron pipes or the PVC pipes. CPVC took almost about 3 to 4 years time, after Astral brought Lubrizol, but changed the complete business dynamics. So almost about 75,000 crore PVC business went under change to CPVC pipes. That was a disruptive thing that happened. So that's how we look at our businesses. That is there a case for a product which is being introduced, and can this product or can this service sustain that kind of growth over longer periods of time?
And how do you manage the volatility?
Volatility is indeed there in our genre, because a lot of times the time that we invest into these stocks are not as liquid as some of the larger mid caps or the large caps. So yes, in case if there is a demand supply mismatch, you could see very erratic price movements into these stocks, and we are completely cognizant of that. So here again, what we do is practice something as staggered investing. So we never go all out in terms of investing 100% of the capital that we have in one shot. So we understand that the market can show us very very erratic price behavior, and that's volatility, right? So we rather use that to our advantage. If you haven't deployed your last penny, you have funds available with you, you can actually leverage this erratic price movement to your advantage. And that's what we look to do. Once the business scales up and there is reasonable visibility and the volumes start building up, over a period of time, this volatility tends to go away. So it's only in the initial years that you see that kind of an erratic behavior. Once the companies are more established, more visible to the broader markets, then these are as liquid or as normal as what anybody else would be.
Sure. So can you also talk to us about the performance piece? What is the CAGR return since inception date, and how many years has been into existence?
Sure. So I'll rather tell you, what's the return since the time that we started taking third-party capital, which is from April 20 onwards. So for the last 4 years, we've delivered about 55% CAGR returns. So that's where we stand. If I go back to the time that we actually started Equitree in 2012, for the last about 11 years now, 11, 12 years, we've been compounding at 32%. So that's the return that we've delivered over the longer period of time.
It's a remarkable achievement, I would say, Pawan. Kudos to
Thank
you
you.
and your team for setting up a strong process in place. Because if your portfolio is growing at 26% year on year, then you end up getting 10 times returns in 10 years. So 1 crore eventually become 10 crores in 10th year, and it becomes 100 crores in 20th
Absolutely.
year. So
So so you're right, because in fact that's the way we look at our compounding, and Interestingly, all of these returns that we're talking about have actually happened because of the underlying growth of the business. So the valuation of the companies when we invested into them, back into 2017, 18, when we started, was close to about 12, 13 times. And even today, the portfolio continues to trade at about 16 times FY25 numbers. So this is not, the returns have not come about because of a substantial re-rating of the stocks, but primarily because of the underlying growth. And that's the way we look at our investing, because if my business can compound at 25%, valuation remaining the same, I know that, I have a multi-bagger over a longer period of time.
So, Pawan, want to read your mind a couple of quick round of questions for you. So, one is that let's talk about 2020 onwards. So, 2020, you took the license for this particular strategy. Is that correct understanding?
No, we took the license in 2017. That's what I mentioned to you, but we didn't raise meaningful capital. So, wearing some small money that came, that was the only capital that we were having until 2020.
Yeah. So, as per the SEBI track record, of course, 18, 19 were very bad years, particularly for small cap. But if we have to look at the CAGR since inception, then what would be the numbers?
So if you look at the SEBI track record since inception, that number shows, I think, about 6.5% or thereabouts. But that has a bit of an anomaly because one, we did not have as much capital to begin with, and the way TWRR functions is that the capital on day one, it's the return on that capital which gets reported. So if there is some capital which has gone out of the system, which was available to you on day one, that impacts and dents your reported TWR. So in fact, that's the reason why the reported TWRR on as per the SEBI shows a lower number of about 6% or thereabouts. In fact, my first investor, their TWRR still is close to about 13-14% or thereabouts.
Sure. Can you deep dive a bit more about TW, how it works? That you said that if suppose there are 10 investors and I take the money out, how?
No, so the way TWRR functions, Vikas, is it starts with a initial capital, and it negates any capital which is coming in between or goes out. So it doesn't really impact. So it's as much as what a mutual fund NAV is computed. So what happens is, in our case, for example, on day one, let's say if I had 100 rupees to begin with, the performance of that 100 rupees is what is computed. But out of this 100 rupees, if let's say 50 rupees is gone out and I'm left with only 50. Now, if the 50 rupees went out in the COVID period, which obviously impacted the NAV, so to speak, the balance 50, which was still remaining, recouped the entire thing. And today is, close to about 13-14% kind of TWRR. But the loss of that initial capital, which was not available to recoup, is where the numbers actually get truncated.
Okay. Okay. And typically, what kind of churning ratio you have observed? Let's talk about last 4 years.
Very less. I mean, ours is practically a zero churn kind of a strategy. So far as we sell only in 2 or 3 cases. I would sell a particular stock only if I realize that, either we have gone wrong or we see that the valuation is running way ahead of our comfort zone. Or lastly, if we realize that the growth potential is kind of stagnating. These are the only 3 reasons for us to sell. Otherwise, we are quite comfortable to hold on to our investment for as long as what we have to. We have investments in our portfolio which we would have done at least about 6-7 years back. Some of them have become 10 bagger, 20 bagger, and we still continue to add those names.
Yeah, so I got it. So hardly 2, 3 changes that
Correct.
you hardly see and quantify in terms of numbers, and maybe perhaps less than 20%. And that is only because of the times you have to buy and sell stocks and rebalance and change the weightages. Maybe that would have account for 10 to 15%, or maybe the real changes would have been less than 5%. Can I say that?
Real changes, the real changes would have been actually less than maybe 5%. You are right, because over the last 7 years, maybe we would have exited about 3 or 4 stocks completely, and we would have added maybe just about 3 or 4 stocks. That's it. In fact, in the last 12 years, since we started Equitree, we've invested in only about all put together 42 companies. So, and of this 42, we still continue to hold about 15, 16 companies in the portfolio.
Right. So, Pawan, do you define your universe or you're open, quite flexible from 500 to 5,000 crores?
We're quite open. So our sweet spot generally is close to companies in the market cap range of 1,500 crores to 2,500. That's our sweet spot, because that's where we look to buy 2 to 3% of these companies when we look at taking meaningful stakes.
So, how is your company structure? You have analysts reporting to you. How many team members are there in the investment team?
Yeah, so it's Suneet and me at the top. We with two founders of Equitree. We have a team of 5 people in the research team, and then of course you have a team on back office and compliance and so on and so forth.
So, you prefer to do your own first-hand research at times when you are evaluating these mid-sized
All the
companies?
times, all the times. So we do our own ground up research. We spend a lot of time meeting company managements, spending time with them at the shop floor. So it's not just meeting the promoter in a hotel or in a boardroom or something, but it's going down to the shop floor, spending a lot of time with the second tier management. Uh, Not just that, like I mentioned to you, there's a lot of scuttlebutt that gets into in terms of understanding the whole market dynamics in terms of vendors, in terms of the peers, and so on and so forth. So there's a lot of groundwork that we end up doing.
Company gets, you prefer to take 5-10% kind of weightages to start with, or you build a position with 1% and start building up, or it depends on the valuation?
It depends on the company and our comfort with the business. So there are times where we could start with the smaller allocations and then build up as we get more comfortable with the business and with the execution that is happening, and then take it up to higher stakes. At times, there are companies which we would have been tracking for very very long periods of time, and there is reasonable comfort, and then maybe you start with more higher numbers to begin with.
Okay. So, Pawan, you've been investing in markets for over 2.5 decades now. And let's talk about 2012 onwards, and more particularly 2017. Now, during this time of, I won't say 14 years, but I would look at it, I have to look at last 24 years of data points. There are 158 companies which has grown more than 100x. Uh, what? So tell us and share your valuable experience of you witnessing any of your portfolio companies, maybe here or maybe the previous avatar, which has grown 100x. If you could give some examples, I don't know, would you mind doing so?
I'm still waiting to get the first 100x in the portfolio. So the max, I think the best performing stock that we have has been close to about 30x now, or close to about that. Uh, so here's the thing. I mean, in the last 25 years, one thing that I've learned, Vikas, is money is not in identifying the investment opportunity. Money is about knowing when to exit, and that's where you end up making these kind of 100 baggers or 50 baggers or 30 baggers and so on and so forth. What invariably happens is that investors tend to sell very early, because you made 30%, 50%, 100% in a short run, and you tend to exit without understanding that what the business real potential is. Likewise, when you see the stock price going down, a lot of people run into booking losses, because you tend to practice the stop loss, which gets typically triggered at 25% or 30% fall. In this genre or in any investment, uh, If you understand the business that you are holding and understand the reasons for the price going up or price going down, that's where you can take a far more informed decision with respect to when you want to sell. So at times, even a 50% fall may not demand somebody to book the loss and get out, because that just could be because of the external factors and so on and so forth. Or maybe two bad quarters in a business, or maybe one bad year of a business. But that still doesn't structurally change the long-term business opportunity for a company. Likewise, just because the stock has gone up, 3x or 5x, and like you mentioned earlier on, you tend to recalibrate the portfolio in terms of your portfolio sizing and so on and so forth. That's like punishing your best student because he scored a 99% where the average class is scoring 50 or 60%. You don't end up doing that. You rather ride your winners for as long as what they continue to show that kind of a growth and the valuation is comfortable. So at the crux is about knowing the business that you are holding and the potential what it can achieve over longer periods of time. So we spend a lot of time assessing exactly that thing with our businesses. And so long as we are comfortable about the growth, and it's not plotting the growth on an Excel sheet, but every 6 months, every 1 year, being on the ground, assessing that, okay, let's see what next 12 months look like, what next 18 months look like. And then you keep taking those kind of piecemeal decisions.
Yeah.
So just to give you another example, the 30 bagger that I'm talking about, it's a company called HBL Power that we have been investing. I mean, we started buying HBL when the price was about 15 rupees, almost about 6 years back. Today, it's trading close to about 550 rupees. So the journey in the last 6 years have been filled with a lot of ups and downs, a lot of stagnation, not seeing the stock moving even, or moving in a particular range and then again coming down and so on and so forth. What we saw during our entire journey was the fact that the balance sheet is getting stronger and the business opportunity remained intact. Third is the entry barriers were itself extremely, extremely high. So very difficult for somebody to get into what HBL does. And when the numbers started coming about, there's no stopping after that.
Sure. So, Pawan, I want to take your there are few companies, particularly in emerging space, which were trading at higher P's earlier, and I don't want to name them as quality. That's a wrong way of defining them and categorizing them as a quality stock, which the entire industry does. And they were available at 40, 50 ka P and all that, but they are at the same level. Whereas some of the companies which were undiscovered or undervalued has now gone up. So, do you think what are your views on that? First of all, why is it this happened, and where do you see going ahead?
So why has it happened is very simple to understand. It's just too much money chasing a lot of these kind of ideas. It's clearly from that perspective. It remains to be seen whether you see the earnings catching up with these kind of companies as what promises are being made. From our perspective, like I mentioned to you, we don't subscribe to this genre of investing. For us, we still believe in the old saying, bird in hand is worth two in the bush. So if I'm investing in a company today, I would rather look at the profits and the cash flows that they are making today and have an option value that, okay, if certain things were to get right, I may have the upside. But my valuation is always based on at the time when we are making the investment and not looking at the future promises that a particular business may hold.
I was just looking at your before performance, and I saw that you delivered almost 100% returns. The numbers are 1 or 2 months old, but the 1 year data was reflecting as three-digit numbers. So,
Yeah.
firstly, congratulations for the extremely good outcome. I know you don't track the outcome, you only track the inputs, but Having said that, the outcome is immense in the hand of the investors. So this is the feedback on behalf of the investor. But having said that, now the concern is that there are few investors who are concerned about the valuations now. So what would be your message to them?
So the valuations, what people are looking at and talking about is, the index valuations. So if you split that thing into multiple things, if let's look at Nifty, for example, Nifty is still trading at close to about 18, 19 times 1 year forward earnings, which is closer to its long-term averages. Because Nifty has made a new high or closer to its new high, that's kind of bringing in some bit of anxiety into investors that, okay, the valuations are a little on a higher side and so on and so forth. But at 18 times, 18 and a half times, it's pretty much in line with its long-term averages. Likewise, uh, if you look at the NSE small cap index, which is where the little bit of a premium is, so that's trading at almost about 30% premium to its long-term averages. But here's the thing, NSE small cap index, if you look at the companies, their average market cap is close to about 22,000 crores. So first of all, they are not really small cap in the truest sense. 22,000 crore company is a fairly sizable company, so to speak, and it goes right up to 60,000 crores market cap. Now that's where you see a little bit of premium in terms of valuations. And these companies are trading at close to about 30% premium to their long-term averages. When you look at our genre of companies, which doesn't find as much representation in the small cap indices, even if you look at the micro cap index, there again, the average market cap is close to about 4,000 crores or thereabouts. So when we look at our genre of companies between 400 crores to going up to 5,000 crores, there are about 1,600 companies in this genre. And when I look at their average valuation, they are pretty much in line with their 10-year averages. So in this segment, so what has happened is over the last 2 years, there's a lot of money which has come into the market. And that has largely been chasing these larger small caps and the mid caps. That's where you see the valuation slightly at a premium. That money is not trickled down as much into this space. And which is primarily the reason why this space still continues to be trading at about their long-term averages. In fact, like I mentioned to you, our own portfolio is still trading at about 16 times FY25 numbers. So this is a market where one needs to be very granular and look at bottom-up investing rather than looking at the headline indices and trying to make a decision.
So during the conversation, Pawan, you mentioned the long-term averages. Look at 10 years, 20 years historically. Market Ps are in the tune of 20 ka P, and some of the small caps you look at is about 22, 23, and currently it is available at what you rightly said is about 28, 29 to 30 ka range. Now, having said that, don't you think as the market cap is moving from 22,000 crore to almost now closer to 50,000 crore, the entire the range would change. The long term historical numbers would also eventually be changed. So, do you think that that particular lens is the right lens to be? What is your view?
So let me put it this way, because that's a more conservative approach to looking at investing. Because a 10-year cycle, would have seen all kinds of ups and downs. We've seen 2017 euphoria, pre 2018 cleanup that happened, and so on and so forth. And 10-year also includes the COVID time. 10-year also just about starts where, we had the first Modi election that happened, and so on and so forth. So typically, if you look at long-term averages of valuation from a valuation standpoint, they tend to catch up. You may have short-term, deviances and deviations here and there, but over a longer period of time, they will tend to catch up. There could be some improvement again, which is granular, and one needs to look up from a company to company more specifically, where the fundamentals are changing dramatically. So yes, 10 years back, if a company was trading, let's say, at a 10x multiple and doing a 300 crore top line, today the same company trades at maybe 10x kind of a revenue number. They will obviously not be trading at the same 10x valuations which was there 10 years back. There will be some premium that will come about in the valuation and so on and so forth. So that is relative. And that's why I said it is a little more granular, and one needs to look up bottom up, where you take a call based on case to case basis. It's not that one could generalize these things.
Yeah. So you talked about bottom up in your case. You previously also mentioned at the time defining the investment philosophy at Equitree is that you always look at bottom up and it's more of stock specific. But just want to read your mind that within the emerging space or a small or size, mid-sized companies, which are the two, three sectors that you are seeing the earnings are catching up big time? Over to you.
So we're seeing a lot of action in the old economy kind of businesses. So manufacturing, engineering, infra ancillaries, consumer, uh, agri, for example. I mean, the kind of opportunities which are opening up to these kind of businesses is something that I haven't seen in the last 25 years of my investing career. Today, a lot of these companies are going up and setting shops in US, where they are setting up manufacturing facilities in the US, or acquiring a lot of the European front ends. Until a few years back, this kind of a thing would possibly be visible only in the large cap companies. They had access to capital where they could do all these kind of things, go out and look at capturing the market. But interestingly, we are seeing a lot of our genre of companies, the smaller companies in the range of 2,000 crore, 3,000 crore market cap, going out and setting up shops, in US and buying front ends in Europe and so on and so forth. So as the China plus one plays out, and we've seen that happening in the electronic segment, for example, from being a net importer today, India has become an exporter of mobile phones and other electronics and so on and so forth. We saw a similar thing happening in the chemical space, the pharma space, the home textile space, for example, where India practically enjoys almost about 25% market share. Now that thing is trickling down to variety of businesses. So whether it is a valve manufacturing company or whether it is an auto ancillary company or from India, today we are seeing some of our businesses, auto ancillary companies exporting to Europe and right in places like Germany, for example. This is something that we've never heard of, we've never seen of. And likewise, for example, if you look at the apparel segment, China used to have almost about 50% market share, and the business moved from China first to Vietnam, Bangladesh, and so on and so forth. Now, as the labor arbitrage is fading out in these geographies, the business is coming back to India. And we're seeing that the capacities are getting filled up, the opportunities are looking even better, despite the slowdown that people talk about and so on and so forth. Because a lot of these businesses are eating market share from the European customers, European vendors, Chinese competitors, and so on and so forth.
From
So
our
that's
country,
really
yeah, yeah, please go ahead.
that's the opportunity that we are looking at.
Yeah. So from our country point of view, I would say जो होता है अच्छे के लिए होता है, in the sense that if these companies were to go out, lay their hands and try out something in smaller countries like Vietnam's of the world, it's better that they are done. So knowing the fact that now they don't have too many options, they would
Yeah.
prefer to stick to us as an economy and make us become a part of strategic sort of relationship which is sustainable for long. Right, from your end. Now, maybe last two questions, taken a lot of questions, so thank you so much for answering them so patiently. Last two questions about people are painting the entire wall with the same brush, saying that, markets are going to be this, that, etc. And we believe in educating all our investors, and this is an attempt where we invited them. This video will go on YouTube channel as well. What are your two, three suggestions to investors, those who are looking at investing in emerging space where you are, what are the two, three things that they should keep in mind? And probably once you are over, I would like to also add one or two points. Over.
Sure. So very clearly, because markets by its own nature, will have volatility. So that is something that one obviously needs to keep in mind, that there will be short-term volatilities and so on and so forth. More so if somebody is looking to invest into the smaller space, in the genre in which we invest into, the volatility can even be higher. So it's not too much out of context to see the portfolios down by a good 15-20% or even a 25% drop. But that's only mark to market. You end up booking the loss when you sell those stocks at that prices. If you understand the business and if you see the long-term structural story remaining intact, then that actually could be looked upon as an opportunity to build up on the portfolio rather than booking losses. From a long-term perspective, I think the Indian juggernaut is definitely moving, and we will see a lot of earnings growth happening about in this segment, manufacturing, engineering, infrastructure, and so on and so forth. So to us, I think next 5 years are looking extremely interesting from a long-term investing perspective and wealth creation perspective.
Great. With that, we'd like to conclude the session here. Once again, thank you so much, everyone, for participating. In case you have any question, please feel free to reach out to me at vikas@aifpms.com. And if you wish to speak to Pawan, let us know. We'll kind of schedule your meeting with him for you to be able to figure out and invest money there. Thank you. Thank you, Pawan. Thanks for your time.
Thank you. Thank you so much.